Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The combination of investors looking for safe assets and an accommodative Fed have driven down treasury rates and therefore mortgage rates and mortgage-backed securities. Joining me to discuss if there is still further room to fall is Brennan O'Connell, who's the Chief Data Officer at OptimalBlue. Brendan, it's great to see you. Welcome back to Trade Talks.
Hey Jill, thanks for having me back. How's everybody doing at Nasdaq?
Everyone's doing great. We are in week 22 of remote work, and of course everyone's talking about the mortgage market and how there's incredible demand out there, and rates is part of that reason. So do you think rates have room to move lower, and if so, why?
Yeah, it's interesting. We're not in the business of making forward-looking statements, but if you look at the primary secondary spread, which as we talked about last time I was on, is the delta between the yield on mortgage-backed securities and the prevailing mortgage rate, there is still some space there. In July, the conforming 30-year fixed mortgage product, which is the most popular mortgage product, actually got below 3%, and it's first time ever that that's happened. But there's still this additional spread between mortgage rates and mortgage-backed securities. So the Federal Reserve is pumping volume into the mortgage-backed security market. They are doing this to ensure liquidity for borrowers to continue to get the kinds of loans that they're looking for in a year where there's a lot of market turmoil. And that has driven the MBS yield down into sort of unprecedented territory. Mortgage rates have followed, but there is still probably 20 to 40 basis points above average in the spread between mortgage-backed securities and mortgage rates. So not that we would suggest that mortgage rates are going to fall. There's some reasons behind that primary secondary spread being a little bit higher than normal, primarily around forbearance concerns for lenders. But if you look at just what the average is, it's about 120 to 140 basis points. We're at 160. So there is some reason to believe that although we're at all-time lows for mortgage rates, there is still room to potentially fall further.
Let's review purchasing volume and why there has been a significant rebound.
Yeah, so from a volume perspective, the mortgage market has really been one of the few bright spots this year in the economy as a whole. We saw tremendous volume in March. Rates fell quickly, and refinance volumes went through the roof. We saw with our rate lock volume the highest monthly total we've ever seen in March, and then in April and May still elevated volumes overall, but the purchase market in particular was really struggling as folks weren't putting their homes up for sale, or sellers were not willing to go visit and look at homes and make sense. There were social distancing requirements, so people were not in the position to go through the necessary steps to buy and sell a home. In June and July, we started to see an uptick again in purchase volume, which is great. You know, from an economic perspective, people buy homes, they go to Home Depot, they look at other furniture purchases. So for the economy as a whole, this purchase market is really critical. And we saw it start ticking up again. And as of July, we saw our highest total rate lock volume again surpass what we had in March, and that was driven by the continued refi surge that we're seeing with the low rates, as well as the purchase market recovering. So really promising that the purchase market has kind of rebounded.
Brennan, what area are you watching that has been hit especially hard by the pandemic?
An area that's really been interesting for us and that we're paying attention to, we've got a number of clients that are involved in this side of the market, is the non-conforming space. And this really includes two different types of loans: the jumbo loans, which are predominantly bank products. The banks oftentimes will portfolio these as opposed to packaging them into mortgage-backed securities. And then also on, under the same umbrella of non-conforming includes non-QM loans, and those are those that don't meet the CFPB's requirements for a qualified mortgage. So that could be like a self-employed individual who can't produce tax statements, so they need to produce bank statements in order to get a mortgage. So these types of loans, jumbo and non-QM, share the fact that they're sort of orphans for the Federal Reserve policy that's pushing liquidity into the secondary market. They don't qualify for Fannie Mae or Freddie Mac or Ginnie Mae mortgage-backed security. So the additional liquidity in the secondary market that has buffered the rest of the mortgage space has not been there for jumbo loans and non-QM loans. So banks tightened credit. Independent mortgage bankers who were selling these loans into private label securities were forced to, in some cases, stop offering non-QM loans altogether, and was really struggling at the onset of the pandemic. April, May, June, all down. April, May worse than June, but all down year over year. But again, sort of the same story as we saw in the purchase market. As things have stabilized, we've seen a recovery from the non-conforming space, and we were actually up year over year in July from where we were in the non-conforming space as a whole last year. So pretty encouraging.
And to wrap up here, where does OptimalBlue fit into the mortgage ecosystem?
Yeah, thanks, Jill. Should have brought that up earlier. Just to remind folks, we're the largest pricing engine in the mortgage space. So we really connect mortgage investors and mortgage lenders who are primary in the secondary market, and we allow these two to facilitate transactions. And we cover roughly a third of the mortgage space, for, somewhere between the 3rd and 40%. And so we're able to look at a very representative set of loans that come through our platform, and then we're able to talk about like things like we are today, rates and volumes and mix of borrowers and products that are going through the system. So the rate lock as well is on the front end of the mortgage transaction. So we're not seeing loans at closing, we're seeing loans anywhere from 30 to 60 days ahead of when they are actually originated or closed, because we're just seeing them at the time of rate lock.
Got it, Brennan. Thanks so much for joining us on Trade Talks. Great to see you.
Yeah, thanks a lot, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.